Ladies and gentlemen, many thanks for being with us to our first panel on MuMAC 2020 on M&A and private equity in 2020. M&A, private equity in pandemic times. Let me shortly introduce the panel. We have with me Fritjof Franz, partner from Capiton AG from Berlin, a German mid-market fund. Carsten Hagenbucher, partner from Charterhouse Capital Partners from London, focusing on European mid-market. We have Richard Ramsauer, managing partner from VTC Industriebeteiligungen, an industrial holding active in the mid-market. We have André Waßmann, head of M&A from Helbling Business Advisors, also responsible in the board for M&A, doing corporate finance. And we have Philipp Heer, partner from HWF Partners, an M&A insurance broker, very active in the market. Gentlemen, great for having you. Thank you for being with us. And on this session, obviously, we want to dive in the general market, but the general market is obviously somewhat abnormal in these days. And I would like to start with actually, how did you all experience the days and the weeks during the lockdown? How did you see transactions further develop, stop? What was your sentiment? What was your experience? And maybe, Philipp, I would like to start with you, given that I think you have a large exposure to a lot of transactions and have seen a lot. What was your impression?
Sure, happy to. So from our perspective, we had a rather regular March. We had all transactions that were lined up and being underwritten during March complete. It felt a little bit as if a plug was pulled in April, and literally every deal we had on the deal sheet got to a halt. That lasted for about 3 or 4 weeks, and then we saw specific sectors picking back up again. We have been very active in infrastructure renewal transaction during this time. And then slowly we eased back into the general wider PE market, starting off with very selective, smaller add-on transactions in sectors that were pretty much protected from the impacts of COVID-19. We did see a downturn across the board, overall sectors of about 60 to 70% during lockdown period. Over the past, I would say 6 weeks or so, we're getting back to regular business activity, probably even a little more than pre-COVID.
Interesting. Fritjof, what was your view as an investor active in the market?
Yeah, interesting times, of course. So a few transactions were on hold in that period, as we all could see, being active in the market. But also on the other side, the transactions we already have been working on and have been in the process for quite a time. We continued. We maybe had a little time where we, of course, had difficulties traveling, couldn't have like the meetings you have to have usually to proceed and kind of going through the process. But we signed actually 3 deals in that time, which was a lucky situation. So on the one side, we had an exit. We sold a company. Actually was a very long process already. Started last year. We sold it to a strategic investor. And on the other side, the 2 transactions we also signed were transactions not that affected, which was also good for us. And we were quite lucky actually being able to sign. On the other side, some other projects on hold. And now maybe picking up, we could see right after the shutdown that the market was kind of, at least from my perspective, kind of aggressive, I had the feeling, trying to get some deals done because nobody's knowing exactly what's going on, maybe early next year, first quarter 2001. So I kind of have the feeling that, especially the last, I would say 2 months, also I have experienced that in a process that there was kind of a rally to kind of get some deals done. Maybe.
Consciousness coming back, Richard, from your perspective out of Munich, what did you experience?
What did we see? I mean, I think we saw two phases similar to what was mentioned already. In the first phase, lockdown period, things got to a halt and nothing was really happening. Everybody was looking at the damage and just trying to figure out what was happening. After that, we saw a pickup again during the summer, but I think the market just changed in a way where you see different sectors being affected in different ways. So I don't think it's exactly the same. The overall activity might have been picking up, but you see strong differences between the types of deals and sectors, and that's what we see. So there is an overheating in some sectors, clearly, and then you have a large pool of deals where companies are still affected, cash flows are affected, and the buyers and sellers clearly don't know how to deal with the situation. So that's what we are currently observing, and unfortunately, one or two of our deals that were in the pipeline got affected because of that fact that the expectations simply weren't matching anymore.
Carsten, what are those sectors which you see which are stronger, which are ones are weaker, are some priceable at all?
Charterhouse has always focused on very resilient, growth-oriented businesses, so shying away from more industrially exposed and cyclical topics. So for us, basically, it was actually a very busy and successful lockdown. We signed 2 deals, one in the education space and one more like banking software related, and we continue focusing a lot of efforts on business services. I mean, absolutely in terms of overall pipeline. Naturally, the more cyclically exposed businesses, machine building or others, I think there it feels like the pipeline has dried up significantly. Other assets that already struggled finding buyers, I think pre-COVID, probably now struggle even more because some sectors, and we all know which sectors we're talking about here, basically are now really completely out of favor. So there's a bit more bifurcation between healthcare, tech, software, seeing very, very rich valuation levels even higher than pre-COVID, and some other sectors that almost have no buyer anymore.
Yeah, interesting. Having no buyer, I mean, Andre, you look for the buyers and for the sellers potentially, of course, but what is your impression? I know you have some affinity also to the tech sector, so did you see a shift in terms of what's happening?
Well, yeah, we have a very interesting and surprising experience. On the one hand side, deals were quite in a disciplined way conducted, even with companies that are from risk areas like the Lombardie. So we had just closed a deal with a company from there, although the negotiations went a bit rougher and they looked much deeper into the financials and into the business model again, so it was like a bit postponed. This is the one, so we have a disciplined way of conducting these transactions. And on the other hand, in my areas where I ask my clients, what do you think is the best strategic way to go forward? They ask me, Andre, what do you think should I do? When should I go to the market with, for example, financing? It's not necessarily that the market itself really plunged, but I think it's more the anticipating of going down valuations, what has not really happened in that way many experience or many people thought before. And I think we have also to look into the fact that valuations were quite high anyways. So I think we have more a normalization of the situation. And I also believe that we can catch up quite soon again.
So you're optimistic?
I'm optimistic.
Good banker.
Yeah.
No, that's interesting. I mean, in terms of, and I would like to, stress that. I think my impression was that at the beginning of the lockdown, everybody thought that prices would crumble, that there would be, risk factors factored in, discounts effectively to cover for risk. And my experience, at least, was that the opposite happened, right? And I think you mentioned it as well, that basically prices rather went up. and I'm not so sure, is it already part of asset inflation? Is it obviously larger competition for less assets, very focused, as Carsten, you have pointed out? But maybe if you think it's normalizing, do you think the prices, what does that mean in terms of pricing? Does that mean price will go even higher now with more money in the market? I mean, sort of inflation at least. Or do you think they will come down a bit? Obviously, depending maybe on industries. But how do you think the pricing will continue?
Well, our experience, and this is also what we see when we look into statistics, we see that those business models that are quite sustainable and have future demand will increase their valuations. This is what we see definitely, and also with supply going back, because companies don't really go to the market at the moment. They will come back in like Q3, Q4 more. I think with this fact in mind, we will also see a normalization of the prices again in terms of getting back to 2019. But if we look into mid-market valuations, we were at like 10.3 times EBITDA, which is quite high. This was an all-time high in 2019. For the small cap area, we were at 8.5 and now reducing to 7.5 approximately, which is not crashing. I mean, this is more a normalization, and I'm pretty sure that those business models that have a future, like technology, IoT, big data, all these things that are important to many, many industries out there, will catch up again, and those that don't have a future will not necessarily be taken with the market anymore, and they will probably be obsolete in the future.
Fritjof, regarding pricing, right? I mean, are you willing to take these, I say, extra mile in pricing, what we have experienced, sort of, I had the impression there were some surprises in the market. So as an investor, how do you cope with that? You say, well, we'll drop out of the market for the time being. It's simply too high. It's not sustainable, or?
Yeah, that's a good question. It's a tough time because you have results from this year which are not normal. Yeah, you have to normalize and you have to deal with it. So what's happening in the future? What we see much more now is, of course, earnouts. Yeah, so we see the structure a little bit changing compared to last year already. Of course, to maybe work with the uncertainty. Yeah. On the other side, as you all know, we have all collected a lot of money. We have kind of a pressure to also figure out where to invest it and find the niche markets, which all of us very much like. And of course, they're still there, but maybe it's not as easy anymore as it used to be, and it's driven by uncertainties. Yeah? And finding there the right target these days is maybe getting a bit more, not complicated, but it's not that easy anymore. And also then negotiating, of course, the structure has changed a little bit. Yeah. That's what we see right now. Yeah.
Carsten, would you support that?
We are paid to deploy, so I think it's like, yes, it's fine to basically focus for a period of time on your portfolio and make sure they are supported in the best possible way. But ultimately, I mean, our business basically thrives off in investing. And I think particularly for secondary deals, I think you have to pay up because many of these assets were bought in 2017 already at quite high levels. So I think those owners, to make their 2.5 times money, you need basically high EBITDA and you need a high multiple. Why would you sell otherwise? So yes, if they're open for bilateral discussions, but they're not willing to basically just let assets go at a discounted price. So you either pay up or happy to wait for another year and let's talk next year. So I think if you want to play today for well-performing assets, prices are quite full.
Richard, I mean, as an industrial holding, do you look for different niches than effective? Is this your time basically? Because lots of investors drop out of traditional old economy assets, if you like, or at first sight old economy assets, and you have a special look at them and can buy at a discount maybe even in these times.
Well, first of all, I think we're fortunate enough not to be paid for deploying money. So since we are investing our own money, we are operating under a little bit less pressure to deploy funds. So that's a good starting point, I think, in times of these like this anyway. What is our focus? I think we have two directions. One is we're certainly focusing on our portfolio because we're lucky enough to have a very strong portfolio with companies which happen to operate in sustainable industries. So I think adding any sort of value to those companies will pay off in the future even more, because I'm not expecting prices or valuations to drop for these kinds of companies. So that's a rewarding, I think, effort on one hand. On the other hand, going forward, making new deals, you have to just take a closer look if you're investing your own money. I think if you go into any sort of straightforward situation with an interesting asset, strong cash flows, strong growth opportunities, unless we have some sort of strategic or operating angle, I think it almost doesn't make any sense for us to approach the asset given the current valuations. And I think, of course, I would like to see things like flexible structures, earn-out structures, things like that. But in reality, I don't really see a lot of that because there's so much pressure and there's so much competition happening that instead what we see is all equity structures, people moving very fast. So that's the reality. So again, attractive assets, unless there's an angle, we wouldn't look at those. And with other assets, I think there is opportunities opening up in some sort of unfavored industries, because you clearly have them. We haven't mentioned them, but we all know what that is. There is a couple of companies or industries that are completely out of favor with any sort of capital market participant, starting from banks to private equity firms. And there will be interesting opportunities. And of course, we're looking for interesting valuations there. And I think that will be happening more. Yeah, as we've heard in the keynote speech, that the mispricing of assets, that's the area where I see it. The other area with the interesting assets, the mispricing is going the wrong way, I think.
Yeah, it's an interesting market. One thing which I want to mention, dear ladies and gentlemen, is please ask any questions for our Q&A session via the chat function, and we're looking forward to those questions. Philipp, I mean, again, also looking at the current market, right, after the lockdown, I mean, you've seen a lot of processes. As the natures, changed, higher competition, when we talked, you mentioned some exclusivity agreements. So what is the mood in the market? What is sort of the morale also in the market? Has it changed? Is it back to normal also?
It feels like it has changed a little bit in the interim. We have seen more competition in processes, which I think is just a nature of less deals happening, that more players just jump on the fewer assets that are attractive and are in the market. We have seen processes being run much more competitively than they used to be. We have seen the tone in negotiations be a little different. We have seen a lot more situations. So typically in our world, when we run in an auction process, everybody always wants to set up different trees and different bidders and clean teams for structures, and it never really happens unless it's a real high-level asset. We've done those on pretty much every occasion in the last couple of months. We have seen a number of processes where there supposedly was exclusivity in the process, but no one really cared about it at the end, something that I haven't seen in 10 or 15 years. So the tone has become rougher. That seems to fade out a little bit with things slowly trending toward normal, I would say.
Coming back to normal, maybe a few words on valuation. Andre, do you see, I mean, obviously higher prices, but I mean, maybe that's not deriving from a sustainable valuation really, but looking at valuation in these times, I mean, looking at how do you also look at historic financial figures maybe, right? Or how do you look at business models? Is there an extra layer of obviously checking in order to prepare a target to be sold? Or
Maybe two things here. The first thing, financials. We will not be able to look into the future from the historic financials in this pandemic, I think. We will have to look into the sustainability and the potential that we have with a certain business model in the future during the pandemic and after that. This is my personal view, and I'm convinced that this is the right way to look at this. I think in a normal M&A process, it's already difficult to look into historics, but I think now it's even worse because, or even more difficult because the time periods that we call strategic are getting smaller and smaller. So we cannot really foresee what is happening or what is going to happen in 1 year, 2 years time period. So I think, and this is the second point, we have to look into more qualitative things, like what really is the business model? Is it scalable if we come to more technology-based areas? But I think this also applies to traditional companies. Is the business model sustainable? Is it scalable? Is the team the right one that is pursuing this? Do I have a USP compared to competitors? Is the technology the right one, and does it have a superiority that is to be marketed to the stakeholders? I think this is the way we have to look into this more and more, and this is already what we see in the transactions we do, not only in the venture capital area, but also in those that are dedicated to more traditional companies.
Fritjof, as an investor, how do you approach the asset? I mean, is there an extra layer, obviously, of perspective? Now, how do you look at financials, the business model, to do sort of a checking the first box, probably? How do you...
Yeah, as I said before, I think COVID has changed that a little bit due to the fact that we had an impact which kind of is changing, especially this year, financials, or has impacted the financials. Very important to get a feeling of how quickly maybe you can recover, or you have these one-time or these special situation to be normalized in the next years, or what will happen. So it's on the one side, of course, financials, also financing these kinds of deals is also a very important part. You have to also convince your financing partners. And on the other side, as just already, I think we've talked about that, what will happen in the next years. Yeah? So that's the most important. What is changing in a long-term perspective. So we have some sectors, of course. For example, look into healthcare. I actually think there are a lot of opportunities, even more than in the past, as now the understanding of what is happening and could happen and can happen maybe also in the future, and the awareness of certain things has totally changed. We have seen that also in the digital world, due to the fact that, of course, due to the situation, things have dramatically changed, and also I think will change the world also in the next years. And that has to be translated into financials. And that is, to a certain degree, not that easy, as we don't know 100% what will happen, but also will give us opportunities which we see, and we also see that in our portfolio already. We were also very lucky to invest it into companies which also actually picked up during that time, as they were right positioned, already had either the technology or the systems in place, which also were in favor to the situation. Yeah.
I mean, maybe one question, only short question, and I know that our next panel will focus on that more. But given the market, given the potential, further debt being drawn, the question, distressed M&A is maybe a coming wave of insolvencies. Where from a balance sheet perspective, the companies are in distress, but not from an operational perspective. Is that something where you say, well, there might be opportunities in that scenario, or would you say, well, there's enough other things to do? I don't, in addition, have to take care of, restructuring even if it's only the balance sheet, by bringing in cash. Is that something we see there might be opportunities, or would you say we don't even touch it? Because
yeah, in general, we are not a distressed investor,
right.
So that's not our, I would say, home turf. But of course, we have a special situation now, and as you said, if it's more of a balance sheet which is distressed, of course there can be opportunities. We also used them in the past. Actually, we had some very nice, and also if you look in the history of Capiton, we had some very, very good deals, especially out of these kind of situations. So, of course, that's something you have to look at. And, let's see. I think it's too early a little bit.
Yeah.
The state is doing all they can do to avoid these kind of things, which, of course, is good, but it won't last forever. I think that will be much more in the picture first, second quarter next year.
Yeah, curious to see. Richard, is that something also you have in mind and something you would look at? Again, I know you all are not distressed investors, but I think these areas are a bit different. Obviously, it's more about the opportunity of an operational healthy company, but which is financially obviously in distress due to the pandemic, and where you would see opportunities, or is that?
That's the theory. I mean, in theory, they're interesting cases. They're hard to find because in many cases there is operating reasons why people have bad balance sheets. So, but we've done those deals, and we would look at those. Operating distress is not something we're dealing with.
Yeah, good. Philipp, I mean, obviously in these markets, I mean, the deals have changed. The players have a different mood. I mean, as an M&A insurance broker, right? You see a lot. What has changed in your market, so to say, in your service, in your offer? I mean, has pricing changed? Has due diligence changed? What you look at, or what the insurers then later look at? Maybe you want to share some thoughts if there's any.
Absolutely. I mean, our market has moved significantly during that time. I mean, for the positive and for the negative. For the positive, it feels like the entire M&A insurance market has taken a breather. It was a sector that just grew exponentially over the past couple of years when more and more transactions were actually insured. And we have all hopefully taken this time to consolidate a little bit, to reflect what has been good in the past, what has been not good, where can we be better. Insurers and brokers have tried to come up with new solutions, examples being how can we help in distressed scenarios should they materialize, how can we help the growing demand in synthetic W&I products. Those are all movements that have been kickstarted during the pandemic, which I would put under the column of being very positive outcome of this breather that we all had. On a more negative side, we all struggled with the lack of deals. I mean, our industry just thrives on the number of deals, the sheer quantity of deals. We have been in a situation where there were good quality deals, and then the competition on our side was as large as the competition on the investor side was. That resulted in prices dropping even more than they had before. Which at first glance obviously makes a lot of sense, even from an investor's perspective makes a lot of sense. However, it always has to be sensible in the sense that it doesn't help in the long run if short term you get good pricing on insurance, but then you kick out an insurer of the market from the market, and you just have this massive exposure for all the deals they have insured. Everybody has struggled a little bit to wrap their heads around what does the pandemic really mean if translated into the transaction documents and into the risk profile of the particular transaction. Initial reactions from many insurers was just to put in a blanket COVID-19 exclusion, which obviously doesn't make any sense because you can never tailor it narrow enough to only cover those instances. This has eased up a little bit, and now we just see more scrutiny in relation to what effect did the pandemic have on the assets, what mitigation measures have been taken, how have the parties discussed it, so things that any player would anyway do in a transaction. So from that perspective, we have had positives and negatives. I think overall the market has made it through the pandemic quite nicely. And we'll see. I mean, the overall hope is that everybody made it financially sound, and that this run for additional premium will come to an end eventually, because I don't see this going into a positive direction if it continues.
Yeah, interesting that market, if you like, changes a lot as well. I mean, from a insured perspective to the positive at first sight, right, with dropping premiums. And maybe that will make M&A insurance overall more acceptable or more sought for in the market.
I mean, it will. It just has led everyone to be a little more precise and diligent in terms of what are the areas that we really need to focus on in every transaction. And I think, in particular, this time has been used to come up with new products, which I think we as a market need to do more. We're just too young and too small. We're all working at maximum capacity all the time. So yes, there are questions around distressed, and no one has an answer because our market is so young that we haven't seen the last wave of distressed transactions. So obviously, we all have to come up with a framework and requirements on how to deal with it should the time come that these are needed.
Maybe looking a bit at the financing situation. Andre, maybe what is your experience in terms of, I mean, we know the investors, they're looking, they're active, mostly the prices go up, but obviously it all has to be financed. So what does the acquisition finance landscape look like? Do the banks continue? Are they dropping out? Are the debt funds moving more in? What is that side of the field?
It's more difficult, to be frank. So more equity finance deals are coming out, and even those, if you look into maybe not the mega deals, but the somewhat mid-market deals, are more difficult because also those that finance the equity consolidate their portfolio, they stabilize their portfolio, so they don't want to have new portfolio companies or necessarily not certain portfolio companies in a certain area. So it's becoming more difficult, that's true. I mean, financing via the bank has been difficult in the past anyways, coming to M&A. Some structures in between mezzanine is a bit easier, to be frank. Even if you have asset-backed, it's also easier. So I see more questions for, do you have an asset there that I can use as a security? We have done this, for example, in transport and location and transportation, where we have actually a leasing financing. The pure debt, the pure equity is getting more difficult. Debt funds are not necessarily, it's easier with them, but they still have certain restrictions that they also have to overcome.
Carsten, your view on the financing, has it changed?
I see it slightly differently. So we play in the kind of upper mid-market, and as I said before, everything evolves around growth and partnering with management teams and founders. And we've all, I think, lived through the last crisis 12, 13 years ago. And I think we're looking at a completely different world financing-wise today. Because compared to back then, where it was largely bank-dominated, today, I mean, in our mid-market, I mean, 50% plus. Some markets like the UK, 2/3 of the market, in the interim basically is financed through unitranche, alternative debt providers, however you want to name them. And yes, there was also a period of time at the beginning of this COVID period where there was a bit more caution, but now we see a tremendous amount of liquidity. I think in some countries, banks are still closed, but there's a lot of financing available at very aggressive terms. And also those unitranche providers approaching the market in a very entrepreneurial spirit, building in a lot of flexibility for buy and build and transformation. So I think that is also propping up the market and the valuation levels we see today, because that is available. So I think for the right asset, I think there is a lot of liquidity available. That's my experience.
Fritjof, would you support that?
Yeah, pretty similar experiences. Of course, all debt provider were very nervous at the beginning of the COVID period. So the first weeks, I've talked about these deals we were doing through the lockdown. Of course, they were also kind of, okay, what's going on here? Yeah, let's check that out, wait a little bit, let's see what's happening. But I have to say, at the end, not much has changed. Banks, of course, are a bit more complicated, as we all know. That hasn't changed. Debt provider, debt funds, etc., alternative debt providers are still keen to go for good deals. Yeah. We also see region-wise in the DACH region a bit different. So Switzerland, very, very good. Yeah. Much easier also with banks compared maybe to Germany. But in general, I would say the market is still okay, working. Yeah. Yeah.
Richard, is that also your experience? I mean, are you also inclined to be quicker ahead of the competition, despite obviously liquidity in the market, but doing all equity deals? Is that something you work with a lot?
We've done that in the past, and we would certainly consider it now as well. So that's something to move you ahead of the pack. But apart from that, answering the debt side, similar experiences. I don't think there's any radical or structural shifts at the moment happening. It's gradual shifts that we've seen over the past few years anyway, and that's just more and more of that is happening.
Okay. Yeah, maybe I would like to invite the audience also to ask any questions for the Q&A session, and would start diving into a few questions, tweaking them a bit maybe. In terms of size, also talking about technology as a new driver, as a new area, overall, and I know you're obviously all mid-cap plus investors, if I may say so, do you think that given these circumstances, smaller, tiny deals will play a larger role also in terms of add-ons maybe? Do you look at add-ons, small add-ons with a specific technological edge maybe from a different perspective now? Is that something you consider, or you would overall also consider the market for venture capital to play a larger role? Or would you say, well, no, we're looking at what we always have looked at, different circumstances, but business as usual?
Maybe if I start, I think our industry has evolved a lot, and I think also like with regard to like kind of portfolio, kind of operating teams, and like while this was a theme 10, 15 years ago, only relevant for the large cap, I think by now each and every one of our firms basically has also like a kind of operations teams. And with that, you have a lot more resources to also like really actively support your businesses. And buy and build has always been a big theme for us. So 8 of our current 10 portfolio companies, are platforms where we do a serial M&A. And I think, yes, in terms of like, we would currently consider doing smaller deals, starting with smaller deals, but then basically having a very ambitious plan to, triple, quadruple these businesses over a period of 4 or 5 years, and largely M&A led. I think in the past, that was a bit more challenging because you just didn't have the right resources, but now I think that gets easier and easier. And I think you have to be nimble in the current time. So I see quite a few sponsors being also a bit more flexible size-wise, and then typically this is a bit more flexible towards the lower end of the range than the upper end. So absolutely.
Fritjof?
Yeah, absolutely. Same with us. We in all of our investments, I think almost all of them, we did add-ons. We have platform deals as well. It's part of our, at the end, equity story. We have done a couple of deals also this year for add-ons in the portfolio, also through the COVID period. And that will be always a focus for us. Opportunities are there right now, as due to the situation. And and of course you look now maybe a bit different because there are new opportunities. There are also maybe new technologies which you see are helpful due to the fact what happened. It will be I think an ongoing an opportunity to follow. Yeah.
Richard, would you agree? Have you always done it? Will it change in terms of smaller add-ons? Or?
Well, VTC was founded 20 years ago on the idea of industry roll-ups. So we've got a long history on that, and we'll continue doing that. So add-ons are certainly a focus. I've mentioned that before. We're quite cautious in generally moving down the ladder in terms of size, because I don't think that's the right strategy for us going forward. But occasionally we are looking into even growth situations, even you might call them venture capital situations, where we think we do have some sort of angle again and some sort of relation to our standard business. And so we are kind of diversifying out of our original space a little bit, yes.
Andrea, I know that you have a affinity to basically tech companies, new developments, digitization, and so on. Do you see a shift due to? I mean, we all worked with Zoom throughout the. Zoom was a new surprise, and we got to love it. The stock market, and then the stock price went bazooka. And I recall after the IPO, everyone said, well, this is a bit funky and it might not work, and you have data protection issues and everything, but I think it has quadrupled since, if I'm not totally wrong. So, I mean, looking at these sort of developments, looking at smaller ventures coming up with, disruptive issues, is that something you see coming more increasingly now, or would you suspect it to happen?
Also here, I think you cannot really generalize. Maybe yes, but not so due to COVID. I think the entire industry, if you put it into one cluster, technology, be it fintech or others, they are getting more major. So they really grow up and they have larger funding volumes. But this also can be answered with the fact that they improve their business models, that they are more mature into the B2B area. So they are getting better compared to like 5 to 6 years ago, and so they also get more trust into the VC area. I think this is the main area. If you are financing a business model that is dedicated to certain trends, mega trends that we rely on, then this will be the case. Due to COVID, I think we see that investors get more cautious, but they look into this more from a qualitative point of view, not from a business volume or transactional volume point of view. I think I would not say that this is a COVID thing.
Maybe we're running towards the end. Maybe only in no more than 2 sentences. Yesterday there was an article, or there was a news that IG Metall would want to set up its own private equity fund called the BOG, Best Owner Group. And I wonder, Richard, do you see a lot of competition by IG Metall now?
Not on that front. I would be surprised. No, I mean, as you all know, conflict of interest is one of the biggest themes in the industry. And I think we can all find quite a few areas where there is conflict of interest in this area. So I don't see this being a big thing.
Carsten?
Good luck to them.
Good. Fritjof, same?
Yeah, same, pretty much. Yeah.
Well, thank you, dear panelists. Thank you for being with us. It's great. Thank you, dear audience, ladies and gentlemen. It's great having you with us. And we're looking forward to you joining also our next panel, Opportunities in the Distressed Environment. And thank you very much.